Welcome. Thank you very much. And I'm very pleased to have this excellent panel with me on our next discussion topic, which is what do institutional investors expect from asset managers? So I'm Katharina Hedenbrand von der Neyen. I'm head of research at Carbon Tracker. And I have with me, shall we start from left to right, I have Carl Frederick Pollack, who is head of sustainable investment at AP7. Then I have Jessica Ground, who is global head of ESG at Capital Group, and Cliff Speed, who is the CIO at TBO Pensions. So when we look at this topic, we have an entire value chain. We have companies, we then have investors who are exposed to them through their investments and their portfolios, and we have the ultimate asset owners and institutional investors. And we're really having a lot of debate about what is the ultimate outcome that we're looking for in ESG investing, on climate metrics, on other issues. How can the desires and the ultimate objectives of the asset owners filter through all the way through the value chain and get looked at and built into the investment objectives? So what we'll do is we'll look at relationships across that value chain. Let's have some thought about relationships between asset owners and asset managers and ultimately companies. We'll discuss through metrics, what are the requirements, what standards, how do we make them comparable, and ultimately, how does all of this feed into investment objectives, requirements, and outcomes? So if we can perhaps start, so I have the value chain sitting here. So we're almost in a bit of a disorderly fashion, but we have asset owners, and then we have asset managers and an analyst. But the analyst is only going to keep the time. So why don't we start with you, Cliff? What outcomes do you expect from a successful ESG strategy?
Okay, I think it's very good to start with the idea of the value chain, because I'm very conscious that I'm just an agent for the underlying members of the pension scheme who I represent. And so my job is really to make sure that we deliver the return so the pensions can be paid with an acceptable risk. So that does mean that ESG factors are absolutely critical, because if I'm not taking them into account, I'm not thinking about risk, and I'm probably giving up in terms of opportunities. So at one level, you could say it's fairly trivial. I want to avoid those downsides, those negatives, which comes from ignoring or not being ready for ESG risks. Now, to a certain extent, that's trivial. That's a bit like saying your bond manager, just after the bond's defaulted, I didn't want to hold that bond. That's the easy bit. The more difficult bit is saying, how do I have a structure so I actually get the positives coming out of this? What is it that means I dodge the bullets of the bad outcomes, but I'm also well positioned for the good outcomes, because the real rapid changes means there's going to be a lot of winners as well as losers from this. Now, to do that, you actually need a strategy. It doesn't happen by luck or by magic. You need to know what you're trying to get to and where you're going to be there. That's where I think it comes down to partnership. We, as an asset owner, will set various objectives, we have various strategies, we have a responsible investment framework, which says that what we expect to deliver to our members. But we're one step removed. We have to look to the asset owners to implement that. So as a very minimum, I'd expect those asset owners to be aware of what we're trying to do, be aligned to that, but then take that further in terms of real implementation and can demonstrate how that happens, which means engagement. Okay? Now that all sounds a bit woolly, so I always like to try and ground it. I have this hypothetical situation where I sit down, myself, the asset manager, and one of my pension scheme members, who's well informed, maybe knows nothing about our investment. If we went through the portfolio and talked about each holding, what we could say about it? Is that holding an agent for change, positive? Does that have negative aspects? In which case, how's it being addressed? That's the job I'm looking for the asset managers to help me with.
Well, why don't I hand that over to the asset managers? Because I think that we're right in depth in the topic here. How do you see this alignment on strategy and on risk? Is it a risk? Is ESG and are the various components of it a risk factor, or are they an opportunity, or both? And how will you align that with your ultimate asset owners? Why don't we start with Jessica and then Fredrik add into this?
Well, I'm so glad that, Cliff, what you outlined is actually a dialogue, isn't it? And it's a realization that when you are looking at a portfolio, whether it's from a potential risk-reward return and pure financial returns, or also looking at the ESG dynamics, that you can't just pick that up and come to conclusions. And what you talked about is you actually want to have a dialogue about what does this mean. So, for example, we've got high carbon exposure now, but what's the outlook for the companies that you are invested in? Are they decarbonizing, and at what rate? And then what does that mean for my risk? And one of the big trends that we've noticed in the institutional market when it comes to ESG is that we're all in this together, and we're all navigating this probably for the first time together. And that's happening for a couple of reasons. One, the regulation, so things like the Stewardship Code here in the UK, or the need to have TCFD reporting to talk about how you're managing climate change risks and opportunities. Sometimes asset managers maybe only have 1 or 2 year lead times on this. And also, a lot of these, in terms of, if we look at over the history of asset management, actually, we can all talk very easily about tracking error or volatility. We have a common language for that, but we're still developing a common language for when it comes to, as you said, carbon risk or opportunities. Is a high-emitting company that is making wind turbines, and I've had this in a portfolio, is that a carbon risk or is that a carbon opportunity? So I think one of the most important things, and why we love working with institutional asset owners, is that we are not just presenting metrics and data, but in the best relationships, we are having a conversation about those relationships and data, because ESG risk, as much as we've done huge work at improving ESG data, but they're still not quite at the point where we can distill them down to a tracking error. And I can say, you know what, and I know there are a lot of metrics out there. We were just talking about things that would love to tell you that you've got a 1.5 degree aligned portfolio and you can go to sleep. And that is simply not the case. And our most sophisticated asset owners, it's the jumping off point for a much more in-depth conversation about all these trade-offs, risks, returns, and navigating these ESG risks and opportunities. Thanks.
What is your view on, if I jump onto the risk opportunity, we've also heard about regulation and reporting. ESG, what drives your ESG strategy? Ultimately, is it a risk-driven strategy, a regulation-driven strategy? Is it an outperformance one on the opportunities? Is it all of them? And again, then how do you link that back to your asset owners?
So just to take a step back, so AP7 is a government pension fund in Sweden, so I probably more represent the asset owner side. And I think for us it's been very critical to define our own objectives in terms of what we want to do in the ESG space. We've for a long time had an engagement team that has been very strong on the sort of non-investment side of things. Obviously we tried to integrate that into the investment side. But the way I look at it is basically, well, we will never have a more unanimous trend than this one probably in financial markets, for good and bad. I mean, what we are very, very sort of critical about, or what we try to challenge, is to understand the different stakeholders in this value chain. So we obviously have the asset manager, the asset owners, the index providers, the rating agencies, the regulators, the politicians, etc., etc. There will obviously be potential conflict of interest here in terms of what their objectives are. Are they aligned with ours or are they not? And in many cases, they will truly not be aligned with ours. And then we have to think about how do we handle this? How can these two parties that are maybe not aligned be aligned? The fortunate thing for us is our members is half the population in Sweden, and our investment horizon is truly long-term. And if we take ESG or climate specifically, that kind of resonates quite well to have a long-term investment horizon. What I think is a big challenge, on the other hand, for the asset management industry is obviously how many asset managers are there out there that have a business model or even stakeholders that are looking 20, 30 years from now? And that's a huge challenge. I mean, there's a commercial aspect. I mean, potentially this movement is also one of the few since the financial crisis where you can see asset managers actually increasing fees. You know, and that's a consequence of this as well. So there's a lot of different stakeholders, but those stakeholders might also have different objectives, and our role is to make sure that we understand those objectives before we partner with certain of those participants.
This actually brings out a very important point: strategies and time horizons and investment objectives. So why don't we go back through the chain and go back, ask the asset manager again, how can you marry this? Clearly, there is a performance on it, so we all know this is the elephant in the room, isn't it? We have a performance objective, which, how do you marry the time horizon? And then align that with your asset owner. And I'll then ping that question over to you, Cliff, to see how you can actually look at this.
Well, you know, one of the core things at Capital Group that we believe is one of our alpha advantages is having a long-term perspective. You know, we've been an asset manager for 90 years. You know, if you look at a lot of what we talk about, it's about investing throughout the cycle and being consistent. And so, that's naturally why, for a huge amount of time, we've been doing work for a long time into the things like the energy transition, the role of hydrogen, because, one of the things that we also need to talk about is that equity markets should be a great place for investing in some of these longer-term opportunities and risks. So it's really about, when we're coming to talking to clients, it's about helping them understand, the asset class and what's the right time horizon and how ESG might play out and what time horizons it's relevant. And then I think what's also incredibly important is, again, being a longer-term owner and this idea of transition, and helping asset owners understand how long it takes for a company or an asset to perhaps transition and to change their business model. So again, it goes back to having the metrics, and then also, as much as possible, showing the forward-looking perspective on how we think things will evolve at an individual company technology level, how we think things like, looking at some of these companies, looking at a chemical company, they're making quite a lot of their CapEx now in things like green hydrogen, nascent technology. How do we make sure that our asset owners understand those longer-term investments, which we think the equity market should be well placed to take advantage of. It goes back to having this dialogue, because a portfolio alone just will look like a collection of companies, and helping to understand, really show our fundamental investment process and digging down into individual companies.
Which brings us up again on how do asset owners see that strategy, that longer term, but then very importantly, what do you expect? We have to move on to the next step on execution from the asset managers.
Yeah. I think might have been some comment in the previous section about, we talk about ESG, but it always seems to come back to governance. And I can see that flowing through here. So it starts from the governance, setting clear expectations, what we're looking for. We need to have the alignment going there. Some strategies, they're going to be long-term by their nature. If you're investing in closed-end, private assets, there's often lockups involved with there. But some of the liquid strategies, they could be turned over quite quickly. And so ask ourselves, what are we looking for and what do we expect? And we can point to, we've probably got our own little favourite papers whereas it shows you ought to be selling managers after they've outperformed, or you ought to keep managers who have underperformed. You can point to your favorite ones. But we try to avoid too much looking at past performance when we're replacing or even appointing managers. The question is, given their setup, do we expect them to succeed going forward? And that brings us back around to governance. How are they set up? Are they well organized? Do they have good processes, people? And do they have a strategy? Are they clear about what they're going to do? So we've had examples where we have seen managers who've had slightly poor performance, but we can see what they're investing in. They're very clear what they're doing. And so there's a greater belief to work with them and stay the course. It is very disruptive to a portfolio to change managers regularly, but you do need to have that discipline at times. But it comes back to partnership and explanation what's happening. If you see your core portfolio management team getting pulled off to what's going to be the next high growth, high exciting area, warning bells should be singing in your ears. But if you're working with an asset manager and you're setting out plans as to how you're going to develop that portfolio, that is, I think, the basis for a longer term relationship.
How do you see it feeding through? So you assume you have a strategy, you have chosen your managers, you're looking, you have a perspective, you understand that, but then how does that get executed? And really when we start getting towards even that company and the engagement level?
No, I think, it's, where we came from in terms of different financial strategies, it was not so controversial for an asset manager to be selling products that potentially are conflicting each other. I mean, that's, if you're a product provider and you accommodate sort of end clients' demands, that's perfectly fine. I think what we see, at least from our end, we're probably looking for managers that are pretty closely aligned with our own philosophy and our own sort of viewpoints, which is a higher level than, are they using A, B, C or D, E, F? I mean, that's kind of, and here it's an open question whether you, within the ESG space, can be everything to everybody as an asset manager. And I think if you ask me, I think it's going to be pretty challenging. I think you have to choose a side here as an asset manager if you're thinking long term. Which obviously brings us back to the short-term side of things, because clearly there is a risk that some managers want to be everything to everyone and don't really take a stance on this. I think the topic is just too big to not take a side.
Which I think that actually brings us to a very important point. Are we heading for convergence and divergence? But you were going to react to this, so yeah, please.
No, I just think that's such a good point, and it goes back to the governance and can you do everything? And one of the discussions that we were having is that ESG has become so big that quite often you will have clients saying, right, we want the environmental footprint looking like this, and we want the diversity profile looking like this, and the returns looking like this, and could you look after this? And actually, really what's, I think the best managers unpick that conversation and say, well, what are the most important things, or over what time frames, and what are your core objectives? So I think as you know, actually it's important, isn't it? There's this sort of thing, never say no to a client. But actually, ESG sometimes is coming with so many bells and whistles. It's really important when we're talking to clients, what are the most important things around this? What do you see are the biggest risks? Is this aligned to what we think are the biggest future risks? And then how do we design a portfolio that's going to achieve everything? And again, I don't think this debate around ESG has escaped any of our notice, not least because The Economist has featured it so prominently. But I think it is really important that we are very clear about what ESG is and isn't doing, and the very specific role that it plays with our clients, because ESG can sometimes be used about exclusions, positive impact, and dynamics. So it really does go back to both those things, not over-promising and a really strong governance process.
And how do you see, and this is really a question to the entire panel, convergence and divergence and standards. Do we need standards? Do we need comparability? Do we need differentiation? Because I'm hearing managers differentiate. We align them according to our philosophy and strategy. But then there's also got to be a certain degree of transparency. Why don't you kick that off, Cliff?
Okay, so I would expect all managers to have a basic level of reporting, monitoring reporting on ESG. We talked about governance, the social aspect. Again, I expect reporting, and environmental is sort of growing. However, I would be very cautious of then imposing a regime which must be followed. When we start thinking we've got differences in geographies, we've got huge difference in mandates from a long-only equity mandate, maybe a long-short credit, a infrastructure, a derivative overlay. You know? What is it that is common right across there? There's actually a narrow band. But then if a manager says that, for example, I've got a greenfield renewable infrastructure project, well, clearly there are going to be some metrics which are highly relevant there. A global long-only equity is going to be completely different. Which one's right? Well, they can both be right. But it does create challenges for the asset owners, and we're all resource constrained. So it is difficult when you get these lots of different reporting metrics. But can you turn that to your advantage? I think we all know that asset managers tend to be a competitive bunch. So turn the question around. Well, that's quite good what you're giving. Unfortunately, it's not as good as the other manager I saw was giving me X. Go and challenge them, see what they can do. And it doesn't have to be an aggressive way. It's a case of, can we move towards something here? And there's often a good reason why reporting comes back in a certain way. Okay, we can't do it that way, but what can you do? It's that productive conversation. I'm in favor of standards. I think there's, particularly on a global scale, we do need to move towards that, and there's some big steps being made. But I also think there's merit in the competition between different managers, finding out things and pushing the envelope.
And there is quite, you just mentioned the word global, and when we look at this, the GFANZ, there is the Race to Net Zero, there are a lot of these organizations, and actually at Carbon Tracker we happen to be involved with quite a few of them, and I'm involved with some of those. And I would like to perhaps ping it over to you all, to all of you. When we're looking at these initiatives, they are actually trying to precisely go down the line, help asset owners, help asset managers, and ultimately drill it down to companies on, if we look at transitions and transition plans, what do transition plans look like? What does good disclosure look like? Do you feel more standards of these sorts need to be set? We seem to be going down some roads of guidance and standards with then a possibility for the industries and asset owners to fill in. But clearly asset owners and asset managers then have a role to play to fill that framework of these standards. What's your viewpoint on that?
No, I think you know, the initiatives you mentioned and many others are doing a great job in terms of actually trying to push the envelope for companies to start disclosing. I mean, I guess that's the first point, to get them to disclose something, yeah? And then obviously we know quality is an issue. We know that sort of there are a couple of transparency issues, et cetera, but that, I'm pretty sure financial markets be very quick to start actually analyzing those, exactly as we've done with financial data. So that I think is a very promising sort of trend as such. And we don't really necessarily have to know exactly what we do with that disclosed data at this point, because I still think it's early days. We just need to get the data sort of gradually becoming more popularly used among corporates. The other thing that I would say is obviously a little bit tied to the regulation question is, you know, and something that we try to think quite cautiously about, because obviously some regulations hit us as well, is the distinction between what's our legal and our regulatory requirements from a reporting perspective, and what's the reporting required in order to fulfill our strategy. And those two don't necessarily have to be the same. It's not to say that one is, you know, is not necessarily. I mean, I'm perfectly fine, but for me, they don't have to be the same. And I think that's, in our case specifically, I think many of the, taxonomy, for example, etc., there's quite a few of them that are around Europeans today, whereas our philosophy is quite long-term, and if I put it very bluntly, how we appear today is not so relevant for us. But the projection and the trend and the momentum we can have in something, that's quite a difference. So it's almost like looking at it, our sort of climate program is more of almost like an infrastructure project, which is very long-term and can be sort of a J-curve. But in order for that in order for it to have resilience and to stand true to that, you have to have super strict alignment between all your stakeholders, all the way from investment team to senior management to the board, and you have to weather that strategy and make sure you stay true to it.
Asset managers, how
So
you see that?
one of the things is I think we need to level set. I was looking at a portfolio, and it was just a few years ago that the coverage just on carbon metrics was well less than a third of that portfolio. We've made great progress. We're getting well over to 3/4, but I think it's really important to realize the context that it took us many years to align on things like simple financial metrics. We're making tremendous progress on ESG metrics. But it is still building towards that. And so, we're going to be having things, we're going to be reporting things, next year like PAIs or taxonomy alignment. And there's going to be some sticker shock because when we've run portfolios through, the coverage is very, very low. And I think we're all going to need to realize that we're starting to have frameworks, we're starting to have that kind of line of best fit as you talk about. But when you get it and the taxonomy alignment looks incredibly low, that doesn't mean, don't jump to the conclusion that your manager is not thinking about that. And we're going to need to, it won't just be a matter of collecting these reports and collating them, it's going to be sitting to understand them and to go for that. So, as with any journey, everybody in the ecosystem is going to need to move forward with that. In terms of frameworks and sort of global, we're huge supporters of IFRS and SASB, and we've written about that publicly. We are huge supporters of TCFD and produce that as well. I think that's incredibly useful. So we are definitely trying to move to do the ecosystem. But all of this frantic activity hasn't yet, if you just read headlines or energy, hasn't quite yet led to reports that are particularly meaningful. And I still think that's a couple of years off.
Yeah. I must say, I've got sort of I can see sort of mixed feelings here in that very keen to get stands. So I've got some assurance. The numbers I'm seeing in different reports are really comparable, okay? And I like the competitiveness I'm seeing within the manager landscape of, I've reported on this, look at how my report has improved, the coverage has gone up. I've got a concern about standards that I'd like them, and I'm not sure how this gets enforced, to become that minimum bar, that people are encouraged to go over and above them. There are some standards get in place and they become the ceiling and no one goes beyond. That to me would be a failing.
Completely agree. Bit of competitive tension is always good, isn't it?
And when we look at that ceiling and the minimum bar, what do you think? Are there roles to play by stock exchanges, regulators and the likes to set that minimum bar? Or what role could those institutions play?
I mean, we are seeing it. I think a great example of maybe that where a regulator is trying to drive up is what's been happening with the Stewardship Code. Yes. We've just, we were very excited to have our second year of being accepted with that. But, you get feedback on you need to improve these areas. So you do set around doing that. So I think that's a great example of where you have a regulator setting out a framework, but because it's annual improvement, they're actually going, come on, this bit needs to be better. Whereas I think as compared to the other hand with the PAIs in the EU, that's going to be very formulaic and there's less room for innovation there. Although my theory is that because the numbers themselves are going to perhaps be a bit confusing, that people will have to build a narrative, and that's where you'll see the competitor. And one of the things we haven't talked about, which I think is incredibly important, I'd love to have your views on, is the case studies, the examples around this that really bring it to life, or some of the things that we're seeing are happening around impact assessment beyond that. I think that's, I think that's going to be the next frontier.
Yeah. So two thoughts. I mean, first of all, upon the stewardship code, I think the stewardship code is a good example of what you may call almost a J-curve in the development. I've seen managers who've actually failed to get approved. And I think that's a good thing. You say, well, how can it be a good thing if people aren't meeting the stewardship requirements? That's because the requirements have gone up, and they do get the feedback. And so actually, there is progress, there's improved oversight, I think, of the assets, and that is positive. It is difficult to go back to your clients and say, actually, we tried and we didn't get it. That's a really embarrassing conversation. That's a hard conversation. But I think it shows that there needs to be, behind any data, understanding, and it's not just a number. What does that number mean? There needs to be that conversation, and it's very true about the examples. It's difficult with all the new metrics coming through. How do you get a feel for that? And stories, narratives are really important. And some of them are pretty easy, be it around building renewable energy. I've done this, and you have so many metrics around it. But there are lots of other areas. But one word of warning for people going in and talking to asset managers: don't accept their first story. They've always got the one story there, the anecdote they'll wheel out. Oh, that's interesting. No, tell me about your next one. Maybe accept the third or the fourth. Or maybe ask someone else in the room to tell you about it, because that's a demonstration of actually being integrated. Are the whole team there? Do they know about these stories? Are they thinking about it? It's not just the surface. Let's see if there's more substance to it.
What is your view on asset managers and asset owners engaging with companies, and how can that engagement be fruitful to really feed through back into the strategy and bring forward the strategy?
Well, if we were to split sort of the financial industry into two camps, the exclusion camp and the engagement camp, I mean, it's pretty clear we're in the engagement camp. I know it was touched upon in the previous panel, whether you have a responsibility to continue holding. I mean, in our case, we don't exclude any sectors or industries per se. But the few exclusions that we do is those that we considered sort of, from an engagement perspective, a little bit of lost cases. It's nothing we do permanently. I mean, if they do shape up, we're happy to engage and invest in them again. But it's there will, I probably stop there for now.
Which that, if there is any, why don't we go through, if you, for each of our panel, a concluding statement or a conclusion from our discussion, then we go left to right, before we move on to any questions in the room if there are any.
Okay, alignment is probably the thing I would start with. There is quite a value chain. There's communication and potential for miscommunication. And also, I ask people to bear in mind that we're still learning in this at all stages. In this room, we've probably got some very knowledgeable people in this area. When I talk to my trustees, some of the decision makers, they're struggling with the language. They're not sure if it's the right thing. They're nervous about this. So making decisions moving forward is quite hard, and they will naturally look over their shoulders, seeing what their peers are doing, asking what market practice is. It's evolving. Show me the hard evidence. I can't, it doesn't exist. We haven't got the data. So there's a leap of faith which is required from the decision makers, and so there needs to be an element of patience, and yet at the same time we realise this is really urgent. We need to be doing this now, if not yesterday. Okay? So there's a little bit of a dilemma there, but once you do have things set out, as I said at the start, I would expect and want the asset managers who are implementing that to be aligned, know where we are, and then pick that up with what we're saying and take it further. Here's how we can actually implement it, demonstrate the engagement, and give us the feedback of where, if our direction could be better. So, well, you're saying this. It's actually really difficult to implement, but here's something which achieves something similar. Very happy to have feedback in that direction.
Jessica.
So I'm about to celebrate my 25th year in asset management, and I would really echo what was said before, is this is the most significant innovation that I've seen in the past 2.5 decades. And it really is shifting the conversations. You know, I've done trustee meetings during all of that time where it used to be, you know, here are your results, here's my biggest contributors, here are the biggest detractors, this is what I was going to think, you know, and either you go, well done, or try better. All of a sudden, we're talking about a whole new dimension to the conversation with an asset owner. It's around, here's how I've been engaging, here are the ESG profile of your portfolio, here's how we're managing climate change risks. That is a huge shift, and I don't think we should underestimate it. So I think I would really want to echo, I think governance is key, and that requires more dialogue and more investment from both sides to really get that alignment. I think that any manager that promises you they can do anything and make all your ESG wishes come true, I think, you know, the best conversations are the ones where we spend that time really understanding, you know, really getting that alignment will be incredibly important. But, you know, I think the final thing that I would say is I completely echo that this is about driving ongoing improvement and innovation. You know, we've talked about reporting, we've talked about metrics. And so, you know, and we are only at, we're really only at the beginning of that.
Carl-Fredrik, would you like to share a conclusion?
No, I think for us it's important to always remember what's the sort of either marginal impact on corporates and real world in everything we do. Like, I mean, we have so much, well, we have a lot of, we're flooded by ESG metrics in different shapes and forms that, you know, it's a challenging landscape to navigate to some extent. But the big question is, do we have corporates that actually care about whether they're graded C or D? I mean, does it have any impact on them? Because if it doesn't, then, you know, what's the point there? So for me, it's the feedback loop to the real world. That's super critical. And the other responsibility, I think, for the whole financial industry is to make sure that this exercise doesn't become too much of an, you know, the industry has done financial engineering for a long, long time. I mean, don't turn it into ESG engineering for the sake of, we can all change denominators and, you know, normalize in slightly different ways, but if the raw data points are pretty much the same to begin with, we don't need 1,000 metrics for the same thing. So that's my view on it.
Thank you. So if I sort of draw all of these together to some conclusions, I think some of the big conclusions, we are all on the journey. We're all still learning. We're all still having to raise the bar. And we're having to do that. Partnership is key across the value chain. The underlying quality of the data and of the action is key, which then feeds into alignment. But that being said, each of the segments within the value chain have their job to do. Corporates on reporting, asset managers on challenging, on being in partnership with the asset owners, and the asset owners themselves on challenging the asset managers and expecting and fostering that competition. Thank you very much. We had one question in the room, which if we could bring that up again, then we can have a short stint at that. So the question was, how far are we from these ESG metrics being integrated in portfolio allocation, decision-making, instead of simple reporting? Would anybody like to take that?
Well, from a firm that does a huge amount of bottom-up fundamental analysis, you know, that ESG data is absolutely, you know, how we move from, oh, do we think a company is managing ESG risks and opportunities well, to incorporating it into an evidence-based way. And we spent a huge amount in bringing raw data in from a number of sources, cleaning it and normalizing it to do it. But it'd be really interesting. I'm sure you have a different perspective as a...
Well, I think at different stages. So when we look at strategic asset allocation, we're looking at climate stresses, climate impact, and that is feeding in. That's just one example. And I think we do look to our managers to have more granular impact, but I'm sure we need to connect this. But of course, all this comes at a cost and it takes time to develop. And we still have to have that overlay, and the challenge I get, is everything you're doing, is it really valuable to the underlying members? And that is something we must come back to and make sure we can demonstrate.
Thank you, all of you, for that very rich discussion. We have run out of time. Thank you very much for the audience.